What's going on, guys? Today I wanted to go over one of my favorite stocks in the stock market, and that is Facebook stock. And right now it's dropping through the floor, and I've done an analysis on it before, but honestly it keeps going back to these price levels where it gets very, very interesting. So I hope you enjoy the video. We're going to look at the stock, we're going to analyze the price, we're going to look at based off forward PEs and forward PEs of related companies. We're going to look at price targets from analysts. We're going to basically look at everything, look at the recent news. So sit back, relax, and enjoy the video. If you do like the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So as always, we like to start by looking at the chart. Look at kind of the technicals, look at kind of what's happening here over the last kind of few days, few weeks, few months. So as you can see, kind of in the last day, Facebook stock has actually bounced back up 5%, a little over 5.37%. So overall had a very good day today, and really, I mean, it was just being down way too far, and basically it's kind of just bounced back as people have gotten back into the stock. Really no news related to that bounce there. But in the last 5 days, we've actually seen the stock drop over 5%. So really, you could see down in here, it was sitting actually below $220, so $217 there. If we look at the 52-week low, we're actually at $216.15. So kind of insanely low numbers here for Facebook stock, and all of that comes back here on the news around earnings. So earnings were very bad for this stock. Really the only large kind of cap tech stock that reported very poor earnings. You saw Google, Apple, Microsoft all had very good earnings, and you can kind of see this stock has actually been kind of getting hurt for quite a while. So here back in September, as a lot of the stock market has kind of bled off, Facebook bled off as well. So you can see it was up around 380, and it kind of bled off even going into earnings. You can see down here around 290, so almost $100 down since then. And then obviously with earnings, you saw a huge dip in there. So that's kind of where we saw the stock hit its 52-week high. As you can see, 384 for a 52-week high, and that was around that September mark. And then as the market kind of sold off, you saw Facebook sell off. So overall, things are kind of down quite a bit from its high. You can see 35.76% here from about where its high is at. So overall, very sold off for Facebook stock. So here we have an article by CNBC, and you can see this was posted right after their earnings, and it says Facebook shares plunge more than 20% on weak earnings and big forecast miss. So they actually had an earnings miss, EPS. Their EPS was actually missed by over 4%, which is a relatively large miss. And then they forecasted their revenue beat just barely, but their forecast on revenue was significantly lower than expectations. So here you can see revenue in the first quarter, they're projecting it to be between 27 billion and 29 billion, while analysts were looking for a number basically a little over 30 billion. So relatively, that's a large miss, especially with a market that's kind of looking at the negative side. Most people are looking at this number and saying 27. You know, that's $3 billion lower than kind of what analysts were projecting, which is obviously a significant amount. A lot of their issues they were kind of complaining about were inflation, supply chain disruptions, and overall basically shifts to lower monetization rates. So basically what stands out to me here, the biggest thing is supply chain disruption. So they're seeing supply chain disruptions, and they're kind of projecting that out. But if you look at UPS earnings and Apple, basically both of those companies talked about the supply chains actually improving and things kind of heading in the right direction. So Facebook is kind of saying an opposite, something that's opposite to a lot of big players that actually have a lot more kind of forward-looking data, as opposed to Facebook that's kind of taking third-party data, right? They're looking at their advertising, saying you guys are spending less, so that means you are having issues with supply chains and whatnot. And those are kind of common things, right? Inflation, supply chain. That's kind of what everyone's been harping on for quite a while. And here we kind of have a revelation, a look at what their earnings were. So, right, they had an earning per share for the fourth quarter of $3.67 when they were expected $3.84. And then their revenue, they actually had $33.67 billion when they were only expected $33.4 billion. So that's that small beat that they had there. Here's some kind of misses that they had. So they missed on daily active users. So they only had 1.93 billion users, where they were expected to have 1.95 billion users. Again, nothing really crazy there. Monthly active users was 2.91 billion when they were expected to have 2.95 billion. Again, these numbers are kind of hard to project, and you're really looking at a time period, right, where most people are out kind of doing things, with the holidays going on. So I kind of expect these numbers actually to be lower during that time period and actually pick up here kind of in the first quarter, and then kind of later kind of towards the third quarter as well. So nothing really surprising or overly concerning in my opinion here. If we scroll down a little further, here's kind of something that is slightly a concern, especially for a lot of people that look at Facebook as a huge growth company, right? So they're only projecting revenue growth of 3 to 11% year-over-year growth, which again is concerning if you're looking at Facebook as basically a growth beast, which in reality, right, they're not. They have almost 3 billion monthly users, right, that are using their platforms, and that's globally, right? And we have a global population of what, 7 to 8 billion, I believe it's kind of at right now. So overall, they have a huge percentage of the population using their platforms. They really don't have a lot of opportunity for expansion. Facebook in countries like China, I believe, is even banned. There are a lot of ways kind of around it that some Chinese citizens use to still use Facebook, but overall, right, it's banned in China, and China has a huge population, so they're never going to have exposure to that population. So overall, this growth to me is not overly concerning, especially considering their valuation, which we'll get into here in a second. But if you look at their valuation, right, their valuation is only around a 20 PE ratio typically. I mean, 20 to sometimes 30. And overall, that's not very concerning when you look at companies like Amazon that are at a 50, PE ratio. So really, to compare to what you're buying and the earnings that you're buying at that PE ratio, there's nothing really concerning from having a more stable growth. I mean, if they hit that 11%, personally, I think they'll even beat the 11%. But even if they're at that 11%, I don't think it's overall concerning. They're still growing. They're still headed in the right direction. Still seeing a lot of things in the positive direction. Here, obviously, they also talked about Apple. Apple has kind of made some changes to their platform. There's a number around 10 billion that they're thinking it might have an effect on their overall revenue, in terms of potentially having an effect of $10 billion on their revenue, which could be very concerning. But Apple is not in the game of right, hurting their users within their platform. If Facebook is losing money, and right, if Android and other app platforms make changes that are more conducive to Facebook, Apple does not want to lose Facebook as a customer, and overall kind of lose people and apps within its platform. So they're going to make changes if customers are adversely affected by their policies. Down here is something huge that I highlighted. So overall, they've split their business into basically two functions: families of apps, which are basically all their apps, and then Reality Labs, which is basically their Oculus unit and their wearables, kind of their actual hardware business. So what's interesting is their hardware business right now is actually losing money. So they're operating at a loss. So they had $877 million in revenue, but they were operating a loss of 3.3 billion. So at least when I look at this, right, Oculus and a lot of their reality metaverse is really starting to kick off. You saw a lot of people just start to purchase it this Christmas. A lot of early adopters is what I would call them. So I think this business is going to become huge, right? Even if their hardware is not huge, the apps and the other benefits that they're going to get, the games and anything that you kind of release on that platform, is going to become massive. So I don't see this business operating at a loss for very long. I think it'll turn into a large kind of growth business for them. So as I've done before, if you just watched, I made a video on Google where we did something similar to what I'm going to do here. And this is basically using PE ratios to project what a fair stock price is for a different potential stock. So what we're looking at here is we have Facebook, we also have Microsoft and Google. So we have their PE ratios, their forward PE ratios, what we're kind of projecting that their forward PE ratios should be, and then also what their current PE ratio is. So here we're looking at Facebook, we got their current PE ratio from Yahoo, right? You can see they're sitting at a 16.47 forward PE ratio, which is very, very low. And if we look at their 5-year PE ratio, this is the lowest that we've seen over their 5 years. So you can see here back in, January of 2019. So this was actually 2018, kind of going into the trade war that we had with China. They had a lot of issues with antitrust, and basically it didn't even get this low back then. So if you ask me, right, Facebook is actually more valuable in terms of forward PE where it's at now than it was back then. But anyways, what's most important here is looking at the average over those last 5 years. So we're actually at a 29.58 average. So what we have here, let's unhighlight a couple of these cells. So we're looking at price target and what the potential return is if they were to basically go up to that price target. So basically, like I've shown you before, this is kind of the math that we're looking at. So we're taking the current price, we're multiplying it by the potential forward PE ratio, and then dividing by the current PE ratio. So when we do that, we're getting a price if Facebook was able to go back to this 29.58 PE ratio, the price would actually be $416.67, which presents an upside of almost 80%, which is massive. Here, let's take a look at Microsoft. I think Microsoft is at least somewhat of a comparable company. So if they were to go actually up to a P ratio of 32.57, which I think even for Microsoft is a little bit on the higher end. I think Microsoft will start kind of drifting down because it's a very established business, has a very high market cap basically overall. But if they were to go all the way up to there, you'd see them go to $458.79, which would be almost 100% return. Google, I think, is actually most comparable here. But if you watch my last video, we talked about how I even believe Google is undervalued. I think this is a very low PE ratio for Google. I think they have a lot of growth in front of them. So even if we're comparing a forward PE ratio of 25.58, if we look at what that price target would be, you'd still be at $360.33, which is over a 50% return on your money. And these are kind of projecting 1-year returns. And the last thing up here that I always love looking at is how do analysts project this stock is going to perform. So overall, if we're looking at this, right, these are analyst ratings. You have a lot of analysts covering the stock, which is overall a positive thing. That means there's a lot of kind of people paying attention to it, evaluating it, and the more numbers that you have, the more kind of accurate overall they're going to be. But you have right now 31 analysts saying that it's a buy. You have 5 analysts saying that it's overweight. You have 16 saying it's a hold, and then 1 saying it's a sell. So that's kind of makes sense. A lot of the analysts, right, that used to be a month ago saying that it was a buy, they've kind of transitioned down to overweight or potentially hold. And you kind of have one person, it looks like, who just is always kind of bearish against the stock, who's saying that it's overvalued and you need to sell the stock. So here is where I really like to look at. So this is the high price target, the median, and then the low. And then you have the average right here. So we're looking at the average here, and the average is around $329.28. So if we jump back over here, right, that is even actually below what we're seeing for our Google price target. So to me, that price target is very, very low. And if you look at that price target, that's still, even at that very low price target, which would be a very low forward PE ratio, you're still at a 40% return. So overall, right, a 40% return in the market is huge. That's a very good thing, especially when you can get that over kind of the course of a year, right? Those price targets that analysts are giving out is a yearly target. So I personally am looking at Facebook. I think, right, it's kind of bounced up a little bit in the last couple days. I think as news kind of keeps coming out, and I think as people kind of look at the stock, I think it's going to level off and find kind of some sort of support. And if earnings next quarter turn around, I think you could see it spike way up. If they stay down, you could see it drop even a little bit further down. But I think overall it's kind of sold off to a relatively stable range. I'm hoping to pick up more shares if it goes kind of below, I want to say the 220 range. I really want to get into two teens to 200s. My cost basis right now is actually below 200, but I don't mind averaging up on a price that is so cheap compared to where I've even, purchased a few shares at. So overall, I really like the stock. If you really like the stock, obviously look into it, do your own research. This is not financial advice. Kind of make sure you're calculating your own risk, looking at the numbers and making sense of them. But overall, I love the stock and I think it's got a bright future in front of it. So I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Otherwise, have a wonderful rest of your day.